what we've been seeing right now is that the government has commenced its borrowing plan for this financial year, and they have started with a bang. Last month they came to the market and picked 15 billion. This month they came to pick the IFB, the funds for the infrastructure bond, and they managed to collect 30.5 billion. So this is indeed significant for the market.
Let's talk about the results of this 9-year infrastructure bond, which came out yesterday and today. Sold at a weighted average yield cutoff of 7.293%. As you said, bidding at just over 37 billion, and what was taken was 30 billion. What do you make of events?
What we have seen is that this is a 9-year bond, though it amortizes. So the weighted average tenor of this bond is approximately 7 years. So many market analysts had compared it with other 7-year bonds that are in the market. And right now the 7-year bond trades at around 5.3 to 5.5%. Therefore, when this infrastructure bond came at an average of 7.2%, many people perceive it to be a little bit higher than where it should be. It's about 200 basis points above. Therefore, there are concerns that this bond came at a bit of much higher than they expected.
What do you make of the concerns that the rate was too high, and just explain to us the reasons for that?
This whole issue started probably some time ago. Last month, the 25-year was reopened. The total bids were just about 15 billion, and the government took just about 15 billion at a much higher rate of approximately 10.4%, which to many people was a bit higher because that same paper was trading in the market at about 9.3. That having been done last month, people expected that this month, this infrastructure bond the rate will somehow be correcting what happened last month. So many people expected that perhaps the government might consider splitting this issue into two, perhaps collect some cash this month at a much lower rate of about 6.5, come back, reopen it maybe after 1 month or 2 months, and hopefully get it much lower than 6%. However, Central Bank decided to pick most of it this time, 30.5, which is much higher than where the market expected. Right. So we have the market is currently under shock because people expected rates of about 6.5, yet the average came at about 7.2. Let's
talk about other activities on the secondary market, Fred. The benchmark 15-year bond, there are fears that the yields could be distorted. Explain to us why that is.
Yeah, what happens is because this bond is approximately 7 years, weighted average tenor, on the yield curve, that bond is priced at about 5.5%. Now, when a bond of 7 years comes at 7.2, when you want to price a 15-year bond, probably it will come at above 11%. Now, most of the 15-year currently are trading at about between 6 and 6.5. That, therefore, brings a distortion on the yield curve. This means there are two scenario that is going to happen. Either this new bond of infrastructure will pull the entire yield curve up, or this 15-year, infrastructure will be viewed in isolation as a bond that is off the yield curve, and therefore it will continue trading in its own realm as the rest of the yield curve trades where they have been. And therefore, if this bond is incorporated into the yield curve, we are going to see a significant distortion of the entire yield curve, whereby all the 15-year papers that most people are holding will record losses.
All right, now let's move beyond the technicalities of some of these bonds, and let's just talk about why the bond market has been underperforming relative to the equities market recently.
Thank you very much. Mostly, one of the key reasons why we've had a significant reduction in secondary market for bond trading is because we have one is because there's tight liquidity in the market. The last 3 months we have seen the government take out about 80 billion from the markets, and therefore there is reduced liquidity. And secondly, each primary has been coming at a higher rate, and therefore making the bonds that people are already holding to be of less worth than where they were. And as a result, we're having people feeling a little discouraged playing in the secondary market because they fear recording losses.
All right, let's just talk about how Kenyan bonds are viewed in general. It's a bit different to how it's done in other parts of the world. We know that the central bank has done everything to tame inflation, and it's coming in single digits, around 6%, which is a good figure for Kenya, where we've seen double-digit inflation in recent history. But all of that is not factored in when people look at the attractiveness of bonds. Why is that?
You know, for a very long time, Kenyan inflation rate used to be in double digits, and especially above 20%. For quite a while, we stayed with inflation rates of between 20 and 30%, even above 30% at times. And during that time, there has never been any bond that has a yield of above 14%. Therefore, the Kenyan market learned to use other indices to price the yield. And the biggest factor that comes in is normally the liquidity, the market liquidity, to be able to price a bond. Now what happens is this liquidity is measured by the short-term government borrowing, especially in T-bills. When there is much liquidity, the rates go down. When there is tight liquidity, the rates start going up. Now many people use the T-bills between the 91, 182 and 364 to extrapolate on the entire yield curve. So people have gotten used to using the T-bill as a benchmark for the entire yield curve. However, when there is a significant shift in inflation figures, then people take notice and start to incorporate it. So far, we've not had a significant shift in inflation figures.